Welcome to this Executive Masterclass Explainer. Today, we're doing a deep, data-driven dive right into the fundamental mechanics of commercial real estate. So if you're looking for theoretical fluff, you are absolutely in the wrong place. We're going to break down the highly strategic, measured principles you need to actually build, manage, and scale a profitable commercial portfolio in today's shifting economic climate. Let's get straight to work. Here's the blueprint for today. We're covering 5 core pillars. Welcome to the masterclass: market research and assets, financing and legal frameworks, operations and risk management, and finally, scaling and asset disposal.
First up, welcome to the masterclass. I want to mention right up front that our explainer today is sourced directly from the fantastic text, Practical Principles of Commercial Real Estate Investment by Willem Tait. He's a highly respected management consultant and author. You can find his multiple books on Amazon, Apple Books, or just at a library close to you. Links to Willem's books and authorship profiles are available in the explainer description, so be sure to check those out.
Now, the modern commercial real estate landscape is not what it was a decade ago. Capital is way tighter, municipalities are far stricter with zoning and compliance, and the hybrid work model has literally rewritten tenant space requirements. Which brings us to Willem's core premise on the screen. A strategy that worked 10 years ago can fail today, not because the investor lacks effort, but because the market rules have shifted. Effort simply doesn't equal yield anymore. In this uncertain market, you need a repeatable, data-backed methodology.
Moving on to Section 2, Market Research and Assets.
Because here's the reality: you can't outmanage a bad location. Your asset choice totally dictates your risk profile. Take office spaces. They're facing the massive risk of flexible work shifts right now. Retail? It's absolutely dependent on consumer foot traffic. Industrial properties thrive on e-commerce logistics, sure, but they face incredibly strict zoning laws. And mixed-use spaces offer brilliant diversification, but they demand massive upfront capital. It's a balancing act.
So how do you mitigate that risk before you even buy? Through ruthless market research. You've got to track the macroeconomic indicators. We're talking population growth, rising income levels, expanding GDP. You want to see planned infrastructure, like say a new transit hub being built, because that signals future demand. And of course, low vacancy rates paired with steady rental growth, that's the gold standard proof that a market is genuinely healthy.
To gather all this data, using modern tech isn't just optional anymore, it's completely non-negotiable. Top-tier, executive-level investors are leveraging GIS mapping to visualize demographic trends in real time. They're deploying drone surveys to inspect topography before ever stepping foot on the actual site. You really have to use these analytics platforms if you want to forecast tenant demand with any kind of precision.
All right, Section 3, Financing and Legal Frameworks. Because identifying a great asset is only half the battle, right? Structuring the capital and the contracts is where real wealth is generated and protected. Let's look at leases. In a gross lease, the landlord is the one eating the risk of fluctuating operating expenses, stuff like property taxes and maintenance. But in a triple net or NNN lease, the tenant assumes those operational costs. Triple net leases shift the financial risk completely away from you, the investor, giving you a highly predictable, stabilized cash flow. It's a total game changer.
And financing is equally strategic. Look at traditional bank loans. They offer predictability with fixed rates, but they move at a snail's pace and have stringent requirements. Contrast that with commercial mortgage-backed securities, or CMBS. These are pooled loans offering much higher capital amounts, and they're often non-recourse, so your personal assets aren't on the line. But, and this is a big but, they come with incredibly rigid terms and basically zero flexibility if you ever need to restructure.
So the crucial point here is leverage. Yes, leverage amplifies your returns, but it absolutely amplifies your risk too. A prudent, battle-tested strategy is keeping your loan-to-value, or LTV ratio, below 70%. That 70% threshold ensures you have enough of an equity buffer to absorb unexpected market shocks, tenant vacancies, or a sudden economic downturn without facing the nightmare of foreclosure.
To evaluate if that leverage even makes sense, we rely on the cap rate. The capitalization rate is simply your net operating income divided by the purchase price. It basically gives you a snapshot of your unleveraged yield. Now, a higher cap rate usually suggests a higher return, but beware, it often signals higher market risk too. It's really your ultimate baseline metric for comparing whether an asset is financially viable.
Next up, we have to talk about tax frameworks, because being efficient here drastically increases your net yields.
Think about the 39-year IRS commercial property depreciation timeline. This is a massive non-cash tax deduction. Every single year, you get to deduct a fraction of your building's value against your taxable income, which preserves your actual hard cash flow.
Another absolute must-know legal framework is the 1031 exchange. This lets you completely defer capital gains taxes when you're scaling up. But listen, the timeline is rigid. You sell your original property, you have exactly 45 days to formally identify a like-kind replacement, and then a total of 180 days to close the deal. If you miss these deadlines by even a single day, boom, that tax liability becomes immediate. No exceptions.
Moving on to Section 4, Operations and Risk Management. An asset is really only as valuable as the management team running it. So let's look at risk. Market risk, like a sudden economic downturn, you mitigate that purely through portfolio diversification. Financial risk, like rising interest rates, has to be handled by stress testing your models and holding solid cash reserves. And operational risks, say a major tenant defaults, are neutralized by executing those strong triple net leases we talked about and doing exhaustive due diligence upfront.
You see, proactive management requires a real system. You need transparent communication channels to keep your good tenants happy. You absolutely need rigorous preventative maintenance, fixing the roof before it leaks, right? It means detailed financial tracking with built-in reserve funds, utilizing smart building tech to slash utility costs, and keeping strict adherence to zoning and insurance compliances to shield the asset from liabilities.
But look, even with flawless management, crises are gonna happen. Whether it's a flood, a fire, or your anchor tenant suddenly filing for bankruptcy, you cannot be formulating a plan while the building is literally taking on water. You must pre-designate a crisis response team and have clear communication protocols ready for your tenants and stakeholders. True resilience is built in the planning phase, not the panic phase.
Finally, Section 5, Scaling and Asset Disposal.
At the executive level, you aren't just buying buildings, you're building a dynamic portfolio that has to be continuously pruned and optimized. A scaled, resilient portfolio is built on exact diversification. By balancing assets, like say 30% office, 30% industrial, and portions in retail, mixed use, and niche medical, you insulate yourself. If e-commerce completely disrupts retail, your industrial logistics hubs carry the weight. It's all about unlocking economies of scale and total resilience.
But here's the thing. Holding an asset indefinitely is rarely your best move. You've got to know your disposal triggers. Are valuations currently peaking? Have you hit your specific ROI targets? Maybe the asset is just aging and threatening silent value erosion through mounting maintenance costs. The absolute optimal time to sell is when the asset is fully stabilized with long-term leases in place. You want to hand the buyer a turnkey profit machine, capturing the absolute maximum premium for yourself.
Which perfectly brings us to this vital concluding principle from the text. A good sale confirms that the original underwriting was correct. A poor sale often exposes weaknesses that were ignored. Strategic disposal isn't just an exit, guys. It is the ultimate audit of your original acquisition strategy. If you bought right and managed right, the market will definitely reward you at the exit.
So, I'll leave you with this final thought to chew on. As market cycles inevitably shift, will your portfolio be resilient or will it be exposed? Commercial real estate is a high-stakes, constantly evolving arena, and preparation is literally everything. Be sure to check out Willem Tait's books using the links in the explainer description. And if you found this executive masterclass valuable, please hit follow on our platform for more deep dive, data-driven insights. Thank you so much for tuning in.